Guys, year to date, the S&P 500 without dividends is down 4.23%. And QQQ, the Invesco QQQ, year to date is down 6.63. Now, probably feels a lot worse than that. Why? Because the top 7 stocks, the Magnificent Seven, are down even more. They're down about 13% this year. Now, you've also heard about corrections. You're like, wait a second, how is the NASDAQ only down 6.63%? How is the S&P only down 4%? But we're talking about correction, which is usually 10%. Well, remember, it's where it's at relative to its all-time high. And in early February, the S&P and NASDAQ hit all-time highs. We are down over 10% on them since then. So that makes it correction territory. And I see a lot of people talking about a lot of fear out there in the markets. Now, obviously, I look at fear a lot different than most people. My idea of fear is people don't even want to own stocks. Yeah, in the short run, you see a big run of losses. People are going to say, you know what, that's fear and that's a temporary blip. I don't disagree. I think we've had a big drop over the last month, last 5-6 weeks, and that's probably a little overblown. Now, where's it going to go from here? I have no idea. Anybody who says otherwise is just lying to you. They have no freaking clue. What we're here to do is teach a principle-driven approach to investing. And we know that in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And every single Mag 7 stock, I don't care which one you're looking at, has an incredible story and an incredible future. But our fourth tenet of our principle-driven investing is probably the most important one. It's a great story can become a bad investment if you pay the wrong price. So whenever we're talking about stocks, whenever we're talking about any investment, if you pay the wrong price, you're going to end up with a bad return. This iPhone is a great phone. It's the best phone out there. I know you Android users out there are probably crying and shaking your boots right now. But as you know, let's say this is let's call it your Android. Great phone. At $1, it's phenomenal. Phenomenal buy. At $10 million, it's a terrible buy. The exact same phone. That's all I want you to do when it comes to investing. I put a poll out on X yesterday. This is my poll. By the way, guys, I love doing polls. I love engaging on X, and I'm almost at 10,000 followers. So go in there and follow me at EMPaulG to get me to 10,000. Which one of these Magnificent 7 stocks will perform the best over the next 10 years? I picked the 4 with the highest PEs. Nvidia, Apple, Tesla, Amazon. Here are the results. We had 664 votes in about 12 hours. Boom. These are the results right here. 57% picked Amazon. Guys, I don't know what's going to happen in the next 10 years. What I do know is these 3 companies have a lot of growth potential. Apple, probably not so much. Doesn't mean I'm right, but probably not so much. That's probably where everybody's sitting there saying why Apple is the lowest one at 6% of the votes. However, guys, the one that's probably the most reasonable priced here based on earnings multiple is probably Apple. And look how I spelled Apple wrong because I was focusing on the stock price. All this says to me is that, okay, people are still optimistic about Nvidia. People have always been optimistic about Amazon. And there's a lot of optimism about Tesla still. But here's what's interesting. Someone commented here below and said, I think Tesla's worth $600. I'm not trying to pick on the person that did that. I said to them, what's this based on? And they gave me a few items. Not one of them had to do with value. Not one of them had to do with any numbers. It was purely the story. And I thought that was interesting because it goes exactly to that fourth tenet. They're focused only on the story, to which I'd say to this person, okay, let's say Tesla's currently at 240. I don't remember the exact number. Add a 0. Is your thesis still the same? Yes. Add another 0. Is your thesis still the same? Yes. Take away 3 zeros. Is your thesis still the same? Yes. And that's not investing. A proper investor will make their decision what's a good investment based on the price they're paying. Apple is currently at what? $2.15 a share. At $21.5 per share, I am selling every single person I know into slavery. In some country it's illegal, but I will do everything possible to get as much money possible in so I can buy Apple. And Apple at $2,150 is a terrible investment. Do you see that here? That's what I want you to understand. If that's new to you, but it's making sense to you, you have investing in you. You are a potential value investor. If you sit there and say, this guy's whack, he has no idea what he's talking about, the story is what matters, you are a speculator, Nothing in this world will save you except for really bad losses. And I get it. You're going to have bad losses whether you're a value investor or not. But if you believe that the story drives everything, you might as well go listen to those other pundits on CNBC and on the rest of YouTube, to sit there and realize that you're going to lose a lot of money in the long run. Now, guys, we all know companies this week reporting, and on this channel, this 24/7 channel versus our main channel, we do these updates. We talk about what's going on in the market. And guys, retail sales just came out today, and let me go over that real quick for you. Retail sales increased 0.2% in the month, better than the downwardly revised decline of 1.2% the prior month, but below the estimate of a 0.6% rise. It's a pretty big miss. Now, remember, guys, consumer spending is about 68% or 70% of GDP. That's why everybody focuses on retail, because consumers make up the vast majority of our GDP. Over 2/3 of our GDP is driven by consumers. And when consumers feel good about the future, they're going to sit there and it's going to drive the economy and they're going to buy more stuff. This year, we have a lot of consumer reports coming out. Nike on Thursday. Signet, local Akron company, does jewelry, coming out on Wednesday. Ollie's a discount retailer, coming out. FedEx, if people are buying stuff, they're shipping a lot of stuff. That comes out on Thursday as well. So make sure you pay attention to what we're doing. We're going to sit here and report these things as they come out. Now, guys, it wouldn't be me without talking about valuations. And last week, this is the S&P 500 stock market to GDP. We're about 100% overvalued. 100%. Okay, it's a big jump. For those of you out there who say, oh, stock market GDP doesn't matter, I'll see in a few years. 10-year cyclically adjusted PE ratio that all it considers what money the S&P 500 companies have been making, brings it all to today. It's 104% overvalued. Now, guys, as time goes on, as GDP rises, as earnings increase, these valuations are going to come down, even if stock prices stay the same. That's the key there. And over time, I know that as the U.S. economy gets larger and larger, the companies that make up our economy will become more and more valuable. But again, if you pay the wrong price today, there's going to be problems. Because this is the economic calendar for this week. As I said, retail sales just came out, reported 0.2 versus 0.6 expected. Home builder confidence index is coming out in just a few minutes. Yep, just came out. Housing starts, a lot of these things happening. Fed chairman press conference and interest rate decision is on Wednesday, and that's the big one. Guys, everyone wants lower rates. There's theories out there that Trump is purposely trying to tank the economy so he gets lower rates because of the fact that we have so much debt that needs to be financed, that the lower rates are, the lower that the U.S. is going to spend. Because right now, we're at about $1.2 trillion in interest costs per year. Interest costs per year. That is a lot. We have 340 million people in this country. How many are actively working? Let's call it 200 million people actively working. I don't know the exact number. 200 million times 10, 100, 1,000. So it's about $6,000 per person per year in interest costs. Am I right on that one? I hope I did that math right. But even if it's a lot of money out there. And as interest rates go up and up, that's going to increase the cost that the U.S. government has on paying that debt. So guys, if you like this, make sure you keep going with the channel. Follow me on Twitter at EMPaulG. And if you want to find a community and tools that make sense to you, check out everythingmoney.com. But only go there if you're a serious investor who wants to get better and wants to learn how to become better at this. Thank you for your time.